aspects of wealth planning, and I will be finishing the webinar talking about the outlook for 2018 and, very importantly, speaking through our reactions to the volatility that we've seen in markets over the last few days. So I believe Dave is going to kick off with a technical update. We have had some questions pre-submitted, so probably the best way, if you do have further questions from this, is to email us afterwards. So let's kick off.
Thanks, Phoebe. Well, good morning, everybody. Delighted to be with you this morning. So I'm going to talk a little bit around some of the technical issues and challenges that that we face, I suspect, and having a bit of a crystal ball moment to look forward in terms of some of the things that perhaps we need to be talking clients about. One of the things I would like to start off with is a quick look at Labour tax policy. There wasn't a great deal in the November budget from a financial planning perspective. There were some bits and pieces in terms of a trust review, and indeed Hammond's announced a further review of inheritance tax very recently. But I thought I'll have a very quick look in terms of what's out there in the public domain as regards to Labour tax policy. You'll see on the slide there that actually the two principal parties in terms of Labour and the Conservative are neck and neck, and that was the first poll post-budget. And I suspect that we're probably seeing ratings of a similar nature currently, and so therefore I thought it'd be quite interesting just to see what is out there as we get closer to a general election, or we have perhaps a post-Brexit election in terms of 2019-2020. Of course, the actual general election itself is not due until 2022. Let's have a look in terms of what's out there from a Labour perspective in terms of its tax policy. There's a little bit of facts which we can draw from their June manifesto in terms of the last election. There's a few bits and pieces that came out from their party conference, and I've extrapolated a little bit, so a little bit of finger in the air in terms of potential areas that they may look to. But it may be an area that you may want to start maybe just discussing, or clients may pick up with you in terms of Labour tax plan. So a couple of things there you see on the slide. The first thing is that it's very clear that corporation tax rates will increase under a Labour administration. That's been very clearly signposted by John McDonnell. A return to a rate of something in the area of 26% is something that they are looking for, 21% for smaller companies. Now that puts us back to where we were in 2010, prior to the coalition government we found then. So, and that's broadly the European average in terms of corporation tax rates. But it's a very sensitive subject, of course, politically, in terms of where you peg corporate rates of tax. But certainly under the current administration, under the Labour administration, or potentially future Labour administration, we will be looking at high rates of corporation tax. I think the other thing to bear in mind is that it's been very clear that McDonnell will undertake a wholesale review of reliefs, various different tax reliefs that are in the tax system. And I think the obvious examples there, pensions tax relief, if we haven't seen the demise of higher or indeed additional rate relief, we will certainly see it under the microscope under a McDonnell-Corbyn administration. But you'll see there that where reliefs do not provide what they call a demonstrative benefit, a lot of this is very loose language, but it just gives you an idea that there will be a review which would consider their removal, reform, or indeed their replacement. And we will make recommendations on the structuring of legal vehicles used in tax planning. And in there, you'll see some further detail, but trusts is a good example where they will be looking very closely at the utilisation of trusts in terms of general tax planning. And I suspect if we don't see any reforms in this current government, we will certainly see some reforms under a Labour administration. So corporation tax reliefs, I think, are very much up there as a high priority. If we start looking at other areas, tax avoidance, the general anti-abuse rule, Corbyn again is very much on record saying that he wants to strengthen this. Where a transaction lacks economic substance, quote unquote, it will be considered a sham, disallowed. Very high level, not a huge amount of detail, but there will certainly be scrutiny in all sorts of areas that perhaps at the moment the government is relatively relaxed about. In terms of personal taxation, just drawing from the Labour manifesto from last year, I certainly think in terms of personal taxation we will see income tax rates increase that was flagged up in the manifesto, as I say, from last year. Income levels between 80 to 123,000 will see being taxed at 45. And actually, I suspect if they retain the fact that the personal allowance disappears for £100,000 and above, then essentially the level of taxation will be higher than that in reality. But the headline tax will go up to 45, and incomes in excess of 123,000, you'll see there that there's going to be a return at the 50% band. So that's something again to think about. The other thing which I think is absolutely clear is there's going to be, I suspect, a realignment of CGT rates to income tax rates. At the moment, of course, we have historically very low capital gains tax rates of 10, 20, and on certain assets, property, 28. So I do think that's a very clear, there's been a clear indication of a realignment of CGT rates to income tax rates, and consequently, therefore, I would recommend that clients, if they can, utilize the relatively more benign regime that we currently have to what may be coming down the track in 3 or 4 years' time. Just a couple of other observations in terms of tax planning. I've talked about CGT rates being aligned. I suspect the annual exemption indeed could be frozen or indeed reduced. I think that's, again, an area that perhaps an administration under Labour would look at. Certainly, I think in terms of inheritance tax, we will see significant reforms. John McDonnell's on record of actually loathing the residence nil rate band, and I suspect we will see the removal of the residence nil rate band. That in itself may not be a bad thing because actually no one understands it and it's so complicated. So perhaps there's an upside to that, and maybe we'll see something being added to the standard nil rate band. But saying that the standard nil rate band has been frozen for a considerable period of time, again, a good example of fiscal drag. We may see that frozen again. It's frozen until 2020, 2021. It's not a huge leap to maintain that level of 325, which we currently have. There may be reform around taxation of gifting during lifetime. There may be a maximum lifetime gifting amount, something similar to what we see in the US. Potentially the introduction of some form of wealth tax, not beyond the realms of possibility. And again, that was something that was being discussed in the press at the weekend. There's quite a lot of things there which potentially could occur in relation to personal tax planning. In terms of pensions, there's not a lot out there. There hasn't been a huge amount of detail coming out from the Labour administration. Again, I've kind of extrapolated, put a little bit of a finger in the air in relation to what may happen. I suppose the only one thing I would draw your attention to, and perhaps where future reforms may occur, is in the area of pension freedoms. I took this quote from a CityWire interview with a lady called Debbie Abrahams, who was at that point, back in February 2017, about a year ago, who was the Shadow Secretary for Work and Pensions. And she, as you can see in that quote, has cast some doubt as to the efficacy and the fairness of the pension freedom legislation. It's worked for some people, but I think there is some element of doubt and concern that some people are being disadvantaged by the freedom legislation, and we see there, as they call it, the risk is being shifted onto the individual. Now, there's no hard and fast detail around what they mean by this or what Debbie means by this, but again, I think it's something that perhaps may be under the spotlight as we get closer to the election. And certainly, I think pensions and the area of pension freedoms and the impact on people of that legislation will be reviewed. So, what does this all mean? Well, it's all around diversification. We talk about diversification. Phoebe, we're talking about diversification a lot from an investment perspective, but I think it equally applies to tax wrappers, tax shelters, so that people have different types of tax shelters which behave differently in differing situations. Maybe some action on IHT mitigation, taking advantage of the current rules and regulations. As I say, Hammond has written to the Office of Tax Simplification requesting a review of inheritance tax under the premise of making it simpler. Same kind of idea in terms of trust reform, looking to make it simpler. Make it simpler, but also at the same time, perhaps just nudge the revenue into the Treasury in an upward direction. So I think also take advantage of the tax reliefs that are out there. Higher and additional rate relief for pensions in particular, I think will vanish. Either in this administration, there's the political will, question mark, but certainly I believe in any kind of a future Labour administration, we will see the demise of high rates of tax relief. Business relief, entrepreneurs relief, all these various reliefs and exemptions which we know and love currently, they're all up for grabs. So I think act now if at all possible. Okay, just moving on very quickly then into something a little bit different, digital assets and estate planning. This is not an area that I would normally talk about with any huge degree of confidence because I'm a technophobe. However, it is something that's becoming more important for people. In fact, a friend of mine is doing his will at the moment, and which I'm going to be an executor. Nevertheless, the person who's drafting the will emailed him over the weekend and said, "What are you doing about your digital assets?" So he texted me and said, what does he mean by that? So, and I put him straight a little bit, I hope. But nevertheless, this is something which is more and more coming into focus as more and more people hold assets, whether they are of actual value or sentimental value, online. And you can see there's a whole variety of different things, from online pension savings accounts, gaming and betting accounts, Bitcoin, domain names, eBay trading, photos, cloud storage, social networking accounts, and so on and so forth, with email accounts. So all these sorts of things, whether they have an intrinsic value or not, it's really important to capture that, because so much more is being held in the cloud online. And therefore, wills you need to make sure that the will and the estate planning captures those assets that are held digitally, as opposed to something which is physically in a room or has an intrinsic value you can touch and feel. A couple of other things just to think about, if nothing else, in relation to digital assets, and maybe just to capture on a fact find or when you're in discussions with clients, is that in some situations, if you're anything like me, when you sign up to a website such as iTunes or whatever it may be, you'll get confronted by this very, very long T&C, which you always agree to. You never really look at it, you just agree to it. I agree to this huge amount of legal, quite turgid text. However, that's quite important when it comes to things like the right of survivorship. So, for example, if you look at the iTunes website, in my naivety years ago, I set up an iTunes account, and I thought I owned the material that was on that account. Like I went down to a record shop and I bought a record or I bought a CD. I owned it. It was mine, physically mine. Not the case. If you look at the iTunes T's and C's, as you see there is no right of survivorship. So unless otherwise required by law, and that's an important point, you agree that your account is non-transferable and that any rights to your Apple ID or content within your account terminate upon your death. On receipt of a copy of the death certificate, your account may be terminated and all content within your account is deleted. Now, that may not be such a big issue, but what I think it does show is the broader principle that you cannot take it as read that you own something online. And in fact, you may actually only be licensing it. And therefore, on death, there is no intrinsic value to that. There's no right of survivorship. There's no transferability. So I would urge clients to actually pick out those areas that they believe most relevant, but actually work out whether they own content online or indeed whether they are licensing it, and what rights they have or their estate has in relation to the transference of those assets, those digital assets, to other members of the family or via the will. One other point which I think is important, and I made this point to my friend, is that it's really important with the will, I think now, to make sure that the PRs or lasting power of attorney for your attorney, that they have a list of up-to-date passwords so that they can access savings accounts or they can access email accounts where valuable information may be retained, because you can hit problems where the domain is in a different location. So, for example, if the domain of an email account is in the US, then you're not dealing with UK law, you're dealing with US law. And in particular, you're dealing with something called the Stored Communications Act. And that can cause problems in terms of accessing information and what email providers can give you in relation to you fulfilling your duties as a PR or indeed as a power of attorney. So having an up-to-date password log of all accounts and digital assets, I think, is very worthwhile. And clients need to be reminded of that, I think, in terms of when they're doing their estate planning. Don't just dismiss digital assets and make sure that PRs and people who may have a lasting power of attorney have the ability to access vital information with a password list, which is regularly updated no doubt as it changes. So digital assets, I think, are becoming more important. And it's just something to think about when talking about broader estate planning, to make sure that you capture all the assets that are held by an individual and how they're held, importantly, whether they are physical assets or indeed digital assets. So you'll see there an advice checklist and fact finds in relation to some of the things that I think are important. And as I say, lawyers and will drafters are very much thinking along these lines, and I think it's something we do need to think about as well. Just to finish off on lifetime allowance, so moving into the world of pensions, and you might think, well, what's there to say about the lifetime allowance? It's been with us since 2006. There can't be much more that we can talk about in relation to the lifetime allowance. Well, just a couple of things I think is worth bearing in mind regarding the LTA. We know the lifetime allowance has come down quite considerably from the heady heights of 1.8 million back in 2011 or 2012, and now we find ourselves with an LTA of £1 million, 2718. That's where we find, and in fact, of course, people with DB benefits who have transferred out of DB into DC with these high levels of CETVs that we've been enjoying over the last 2 or 3 years, under the DB regime, possibly they may not have had such an issue or concern around the lifetime allowance because of the way that the benefits are calculated. But under DC, of course, this actually may start to bite in relation to benefits that now sit in the world of DC as opposed to DB. So the lifetime allowance, I think, is going to become more important. It's a revenue raiser, of course, for the Exchequer. It raises about £500 million of additional revenue, i.e. that reduction from 1.25 to $1 billion to 1 million actually has raised about an additional £500 million of tax revenue. So it's something worth having. It's small in the scheme of things, but nevertheless, it's additional taxation. I think the other thing to bear in mind, of course, is the LTA, although it's been frozen and decreased, is now starting to tick up. So we now see the LTA rising from April next year by whatever the CPI number was back in September 17, which was 3%. So the LTA will be just over 1 million, it'll be 1,030,000 from the 6th of April. Now that could mean a little bit of tax planning around the edges for clients who perhaps defer crystallising some or all of their pension benefits to the next tax year, because the LTA will be higher. And as we all know, when you have a benefit crystallisation event, it's expressed in percentage terms. So if you've got a slightly higher LTA figure to work with, you're actually crystallising at a slightly smaller percentage. And therefore, that may help in terms of future planning. And also, you may save a little bit of tax if indeed the clientele, then pension benefits are in excess of their available lifetime allowance. So a little bit of tax planning there to think about. And just to put a little bit of context around the change that we saw in the reduction from 1.25 to 1 million, you can see from the slide there, actually, based upon a CPI of around 2%, to get the million back to 1.25, we're looking until the end of the next decade, 2930, before we see a return to 1.25. So this is another good example of fiscal drag, and it's another area where, although you don't see riots in Trafalgar Square, this kind of tax does start to bite and can bite quite significantly. Just a couple of pieces around this, which I'd like to talk about. We often asked around, well, what kind of returns does my client need in order to hit the lifetime allowance? Here are some numbers which you can see on the slide there. On the left-hand side is the value of the pension asset, the pension fund. There's the term 5, 10, 15, 20, and there's some assumptions there in terms of what the lifetime allowance could be based upon a CPI of 2.5% from 1819. And there gives you a ready reckoner, if you like, in terms of the return numbers. And of course, that feeds into asset allocation, the types of portfolio that you might want to put in place to produce those levels of return to hit that number. And of course, if you put the maximum level of annual contribution that you can currently make, 40k, into that mix, then you get the bizarre situation, particularly with the higher DC fund values, of actually a negative return, which seems to me preposterous. And I can't believe that the architects of this policy really meant that to occur, but that's where we are. So there's quite a lot of advice that's required, I think, around managing the LTA, particularly from that as we see the result of DB to DC, and also in terms of matching or meeting the expectations around the LTA to minimise tax. Indeed, some clients don't care a jot. Others don't want to give up anything to the revenue. So this kind of planning is coming more important, certainly in our experience. In terms of planning challenges, just a couple of things to bear in mind. We've got the interaction, of course, of the various different transitional protection regimes, which in itself is incredibly complicated. And just finally, before I pass over to Phoebe, I would just recommend you have a quick look at a case of Ormiston. You can see there a website address, and this was a case that was heard in December, or the Ombudsman's decision was published in December. And this case, the Ormiston case, is specifically around advice given by an advisor to a client around the lifetime allowance and the reduction, the impact of the reduction in the lifetime allowance and how that impacted on that individual's retirement plans. Essentially, the advice wasn't really followed through that effectively. The Ombudsman found against the advisor in that case, and the advisor is going to have to pay a significant amount of tax on behalf of the client because of the benefit crystallization event. They're over the lifetime allowance, there's tax to pay. But it's all around the framework of how you provide advice that actually may be 5-10 years old. It's really important on the back of that case to make sure that that advice is continually reviewed and made sure it's still relevant, and that clients are made aware, specifically made aware, as to the changes and the reduction in the lifetime allowance. So I'd certainly recommend having a quick look at that case. It's 3 or 4 pages from the Ombudsman, and you can see the link there. And it may just give you a little bit of guidance in terms of what not the regulator, but what the Ombudsman and what is looking for in relation to ongoing advice in relation to the lifetime allowance, and specifically the reduction in the lifetime allowance. So on that note, I'm going to pass over to Phoebe, who will take you through a portfolio update. Phoebe.
Hi, I'm just going to grab the clicker. So when we designed this webinar, when we were thinking of content, we obviously hadn't experienced the market volatility that we had Friday, Monday, Tuesday, and continue to have today, really. Markets are reacting very quickly. There's a lot more volatility in markets now than there has been for the last 3 years, where we've had historically low levels of volatility. But I think what's important, despite this very short-term impacts that we've seen, is to come back to the fundamentals, come back to what we've been thinking about equities and where to invest for the last 18 months, 2 years, and really come back to thinking: do those conditions still exist? Is our thought process, is our thesis still valid? And the first bullet point on the slide there is highlighting 3 key reasons as to why we believe equities are still a good place to be in, and we do have an overweight exposure to equities in the portfolios that we run. Those 3 key reasons here are synchronized global growth. What do I mean by that? That is all 44 of the OECD countries growing at the same time, and that's happened now. That is going on right now, and the last time that happened was pre-2007. So that's a very important place to be. It's not developed markets doing really well, but actually emerging markets going through a very difficult crisis as per 2010. This is not 2013, where emerging markets were doing well, but places like Europe were struggling significantly, and we had the European banking crisis at that point. This is all major countries, all major economies growing at the same time, and therefore providing a really positive background environment for equity markets. We have nascent levels of inflation. That is the existence of inflation in places like Europe, the UK, Japan, which hasn't seen inflation for nigh on 20 years, the US. And the existence of inflation in these countries is positive because, firstly, the debt that the government has been taking on is worth less, and also provides evidence for a growing and healthy economy. In the opposite end of the scale, places like India, the inflation rate there has come right down from about 10% down to about 4.5%. So again, the point there is it's controlled levels of inflation, it's healthy levels of inflation. And this existence of this inflation rate is a positive reason to continue investing in equities. And finally, the last point there, the last piece of the puzzle in terms of the broad brush reasons as to why equities are a good place for us to invest, is the continued loosening of monetary policy, or loose monetary policy, as I put in there. Yes, we have interest rate rises having happened in the US, and actually they're already starting to tighten, to shrink their balance sheet. They do have a long way to go on that project. In the UK, we've had one interest rate rise, taking us back where we were pre-Brexit, and there are a couple more interest rate rises on the horizon from Mark Carney. He's very clearly signposted those. But in the ECB, the European Central Bank, they are still tapering. They have signposted September as a potential point, which would lead them to stop doing QE, but that's not hard and fast set. So that will depend on how the economy develops between now and September. And don't forget, in Japan, the Bank of Japan are still printing at record high levels of quantitative easing. So currently they've printed over 12 trillion US dollars simply in Japan alone, and that continues unabated for the time being. What this really means, and where I'm getting to, is yes, we have interest rate rises going on and planned, but on a relative basis, there is a huge amount of money still going into the system and fluttering around the system, and that huge amount of money, that wall of money, does support us to continue investing in equities. Pension funds, big asset managers are continuing to need income to meet the income requirements of potentially, for example, older clients. They are having to go further up and up the risk spectrum to achieve a set level of income that they need, potentially an increased level of income as we see levels of inflation come through. And as a result, investors have had to go up and up the risk spectrum and are now in what has been very well documented as sort of bond proxy type equities, and all of this sort of wall of money is going into equities and continue to be in equities if they need to achieve levels of income. So yes, we're overweight in equities, and that view has not changed as a result of volatility this week. And I wanted to drill down a little bit in terms of geographies, talking a little bit about where specifically we're overweight. The first one in the slide there is the US. This has been a view of ours for at least 3 years. The US is the biggest economy in the world. Yes, China's catching up with it, but for the time being, very much the most important and dominant economy in the world with the dominant consumer. The US is always the leader in terms of the recovery, and it was the first to recover following the financial crisis. The economy is still very strong. It continues to strengthen. There is strong GDP growth. There are strong employment figures, and actually it was the employment data that came out on Friday that triggered the volatility in markets. Investor confidence is growing, and they have consumers that are much healthier in terms of their balance sheets than they were in 2007. So there are significant reasons on a macro basis for us to be investing in the US. Many people look at the PE ratios as a way of valuing US companies and say, yes, but they're the most expensive in the world and they're not better opportunities elsewhere. That is true, but it's important to look at the earnings growth of some of these companies, or actually the companies in general in the US. It's all very well having a profit margin that's increasing or stable. You can do that by cutting costs. What's really attractive in terms of an investment point of view is an increasing top line, increasing revenue figures. So what are those revenue figures in the US? If you look at Q4 2017, the year-on-year growth in revenue was 19% for US companies. Stripping tech out, you still have 14%, so very strong double-digit growth. Actually, we had our international equity head of international equities present to us yesterday in our Wednesday morning meeting, and he stated specifically that the year-on-year revenue of Amazon was 38% revenue growth. And that's not including the Whole Foods purchase that they did mid-year. So there are some companies, and yes, it's a winner-takes-all type of environment right now, but there are a significant number of companies in the US that earnings are very much justifying those higher than average PE ratios that we've seen out there. We're continuing to use the passive large cap tracker in the US and marrying that with an active mid and small cap manager run by Schroeder. We believe that's a great complement. The small and mid cap sector of the market is more inefficient, and therefore there is the ability for managers to generate alpha in that sector. It's much less easy to generate alpha in the US large cap space, which is why we've gone down the tracker route. Both of those holdings are unhedged, which has caused us a little bit of pain over the last year or so. But over the last few years, that currency movement will very much wash out. Coming on to Asia, Asia is another specific area that we are overweight. We use funds, of course, to access Asia and actually use Asia-Pacific funds rather than specific geographies outside of India. And I think what we're saying here is that Trump's protectionist rhetoric, which he was is talking about to a high degree this time last year, hasn't really come through. Maybe he's had a bit of a reassessment of how he wants to conduct himself in terms of trade and protectionism. The earnings momentum in that sector of the world is very, very strong, and consumers are getting wealthier and therefore having more disposable income. So having a bit more buying power in terms of going out on their discretionary items like consumer discretionary sectors or automotives, cyclical type companies. And yes, the cyclical upswing will benefit from this increasing global growth more generally, and global trade, which is at the highest level it's been for 5 years. What are we doing in terms of Asia and getting our exposure? Very recently, actually just last month in January, we sold out of our first state global listed infrastructure, our first state Asia Pacific Leaders Fund. This fund has been a stalwart in the portfolio and has been in the portfolio ever since inception. However, at this stage, we believe that we want more exposure to growth companies within Asia, and we actually want a greater exposure to China. The first state fund had a fairly chunky exposure to India that we wanted to specifically remove. And actually, with China having gone through a huge amount of reform and being in a much healthier place than it was in 2017, apologies, 2015, when people were having considerable concerns about the authenticity of the growth figures, we now want to start incorporating more Chinese exposure in the portfolios that we're running. So we've now come out of the first state fund and then gone into a BlackRock fund, the BlackRock Asia Special Situations Fund, run by Andrew Swan. And the final geography I wanted to spend particular time on is Japan. You will know we added Japan exposure into the portfolios, into the higher risk portfolios in the summer. We're using Baillie Gifford specifically as a fund manager to access Japan. We're using a large cap Baillie Gifford fund in the balanced portfolio, and then a Baillie Gifford Japanese smaller fund in the growth and adventurous portfolios. Our rationale for Japan really centers around the domestic recovery that they've been focusing on. What we're quite excited about is the reform programs that Abby's been putting through, things like getting foreigners on boards of companies, encouraging women into the workplace, and of course the QE programs that have been going on for quite some time, his 3 arrows. But it's really about the benefit that the domestic economy is going to feel from this. Companies in Japan, or investing in Japan, used to be all about the exporting side of their economy, and they had a big percentage of all of the GDP that was generated from exporters. Now, I think they're much more conscious that they can generate a lot internally. They can focus on services internal to Japan, things like tourism. And there's a big drive at the moment to generate increased levels of tourism within Japan. What that means is that the companies are selling to a Japanese consumer that we've seen are getting wealthier and more confident about Japanese growth, and they're employing a Japanese consumer, so clearly you can see the cycle being closed there. So Baillie Gifford Japanese is focusing on those companies that are based in Japan and therefore don't have to rely on a weak yen to be competitive on a global stage. Clearly, the smaller cap company has a bit more volatility in it as a fund, but the portfolios that we put it into can very much withstand that level of volatility. Of course, we continue to focus on downside protection, and it's very easy for me to sit here and talk about the exciting opportunities, the stories that we have connected to our equity exposure. But I will stress, and I continue to stress, the importance of the risk management, of the volatility management, of the cushion we try and put into the portfolios, and we do that by using the absolute return funds in the portfolios. There is an increasing correlation between equities and bonds, particularly things like government bonds in the UK, and there's an almost one-to-one relationship between bonds and equities. If you look on FE, for example, the FE risk score might be something you're quite familiar with. the FE risk score of a UK government bond is almost 100. And that is showing you how much the correlation, how high the correlation is between bonds and equities. So in that environment, we can no longer rely as heavily on fixed income as being our true safe haven asset in market volatility. And we use the absolute return funds to provide an uncorrelated or very low correlation to the equity market and the rest of the portfolio. And that's really our ballast to the ship. We use a range of absolute return funds, as you know, a mixture of long-short funds, things like the Henderson UK Absolute Return Fund. Very recently, we've added an Artemis US Absolute Return Fund, which operates on a very similar process to the Henderson Fund. The fund manager who came in last night, in fact, even more, buys funds clearly he thinks will do well, and shorts funds or sectors that he thinks will generate negative performance. Thereby, he's able to make money when markets go up and down. He's net positive over this week, which is pleasing to see. However, it should be said that the reversal that happened very, very quickly. So it's sometimes very difficult if it's a quick swing, a sort of whipsaw, as people call it. If there's a whipsaw in markets, it is difficult for some of these systematic fund managers to capture and benefit from that trade. The systematic fund managers do much better when it's sort of continued sell down, as it is in most market crashes that happens over continual days or even months, because the algorithms within the strategies are able to adjust and understand what the movements of markets are doing. We did recently sell our IP, our Invesco Perpetual Global Targeted Returns Fund. That fund is a macro strategy, a multi-strategy absolute return fund. The sales guys, the fund management came out of the old Standard Life Guards team. They split and went to Aviva and went to Invesco Perpetual. And we believe that the IP fund has got to a size now where it's not able to implement the investment strategies efficiently enough and to the best of its abilities. So we don't really believe that it's going to generate enough long-term performance and provide the low correlation that we want for it to be in the absolute return bucket within portfolios. So we have sold it out completely and replaced it with the Artemis US fund I mentioned earlier. So I've got to take it here. So I've just covered here on the slide before we come on to the recent volatility, some other calls that we've made. Europe, it's been holding that we've been increasing throughout 2017, and we've held our application steady throughout this year. Europe as a geography is one that we're very, very excited about. We believe it provides a lot of opportunity. There's a real increasing sentiment in terms of Europe on a macro basis. Lots of the data that's coming out is very, very encouraging, and companies seem to be feeling increased levels of revenue as a result of an improving background picture. We came out of a more value-orientated strategy run within BlackRock by Alice Gaskell and into a higher beta strategy run by Alistair Hibbett, the BlackRock European Dynamic, which gave us more exposure to those higher growth companies, as we believe Europe is at a sort of pivotal point in terms of its development. We've also unhedged our exposure, which has benefited performance quite considerably over the last couple of months, as we have seen a strengthening euro. And really what we're trying to say with that is if we truly believe in the geography, in the background case for investing in Europe, we should be unhedged, because if the economy is going to do well, then obviously the currency is going to do well with it as assets flow into that region. The IP trade I told you about. Infrastructure is one that I'm constantly banging the drum on. This trade was initiated pre-Brexit. We came out of all property exposure, and went into US infrastructure. Beginning of last year, we actually switched out of US infrastructure and into European biased infrastructure via the First State Global Listed Infrastructure Fund, and we continue to hold exposure to that area of the market. It could be potentially perceived as slightly more expensive than other areas of the European equity market, but I think it's important to remember that actually infrastructure is a way of insulating a portfolio against inflation, because many of the revenue streams generated from infrastructure companies, utilities, for example, are inflation linked. So the companies have the flexibility to increase revenues simply by the level of CPI, and therefore that area of the portfolio is more protected against inflation. UK equity has been an area that we've been reducing. That's been going on for the last 18 months or so. We simply see more opportunities, greater opportunities overseas, and I've spoken to you there about our overweights being US, particularly Japan, Asia. We sold out of our UK smaller companies, mid-cap companies exposure in the summer via the Marlborough Fund, which we sold throughout all portfolios. That potentially was a little bit too early, and actually the UK mid-cap space was one of the stronger performing areas within the UK last year. We do have a smaller companies fund run by Old Mutual, Dan Nichols. That's a very, very stock-specific fund and had an extraordinary year in 2017, generating a lot of performance for the portfolios. Our concerns around Europe clearly are to do with Brexit. We don't know what the fallout will be. We're hearing from a lot of companies, a lot of fund managers, that people are putting off investment projects, and we can't help but think that will lead to lower levels of GDP growth, which is why we have reduced our exposure to the UK. We're still in it, and we're looking at sort of 30% of the overall equity holding in each of the portfolios as being within the UK. So we still have quite a considerable amount, but that's come down from about 50% of the equity exposure in the UK this time 18 months ago. Japan, I've been spoken to you about, and India was a holding that we introduced during 2017. Yes, it's a volatile geography, and actually the Jupiter fund that we hold is a smaller mid-cap fund, so it does move around a bit in terms of valuation. That's really the rationale for the 2% position in the balanced portfolio. It does increase as you go up the risk scale, and there's more in the growth and adventurous. We have a really strong and exciting view on India over the longer term. The demographics of the country are obviously very exciting. Modi and his reform programs can't be ignored. The speed and the innovation within which he conducts his reform programs and implements them is a really strong reason to be investing in India. Yes, it can cause some sort of short-term nervousness because he pretty much just announces a reform program and implements it the day after he announces it, which does take some businesses, some politicians by surprise. But really, things like the goods and service tax, removing 36 individual VATs that previously existed in India. So a company would have to have 36 individual tax regimes to deal with to simply just sell to their own country. All of that has been removed in one fell swoop, and he's replaced it with one VAT rate. All of those, that reason, India Stacked is another really positive thing. So he's has an online portal whereby everyone's official document, things like your mortgage agreement, your birth certificate, your driving license, your marriage certificate, it's all in one place. So if a bank wants to lend you money, it could just go into India Stacked, see all of those documents, and very, very quickly loan you out some money. So in terms of credit generation, GDP growth generated by that, it all happens a lot more quickly and efficiently than many, many countries in the Western world. So he is overtaking in leaps and bounds some of the more developed countries, and it's really one to watch and one we're very excited about. So before we go on to the legal information, I will just touch upon this week. As I mentioned to you, Friday's sell-off in the US was very much driven by investors' nervousness that the increased levels or the improving macroeconomic environment in the US, i.e. higher levels of wage growth, would potentially lead to, in the near term, the Federal Reserve having to raise interest rates faster than what's been signposted. Clearly, it's good news because obviously the economy is in a healthier place, meaning bad news for equity investors, bad news for the market. Because if interest rates rise faster than expected, firstly, that's something that's not clearly signposted, and investors don't like anything that's out of the ordinary when it comes to central bank policy. And secondly, obviously, debt increases, the consumer has to pay more for the personal debt that they have. Retailers, manufacturers all have to pay more for their levered balance sheets. And the US corporate is a lot more levered than it was 5 years ago. The US consumer, actually, interestingly, is less levered, for example, than 2007. The US corporate is more levered. So this will be a knock-on impact on the US corporate if the Federal Reserve don't raise interest rates carefully enough. And the concern clearly was very much seen in markets. We believe that the impact, the sell-off was exacerbated by the low vol systematic trading that's going on. Many people had low exposure to low vol funds, low vol strategies. It was a very popular trade, and some of those, the exposure, the huge number of low vol strategies, we believe exacerbated the fall. And it was a pretty significant fall, particularly in the US. You're looking at the biggest intraday fall that there's ever been, 4.6% in the Dow Jones. It actually rebounded to finish the day 4.3, but it's a pretty significant move, and it just really highlights to us the impact of these systematic algo trading strategies, these passive strategies, which there's such a high percentage of all of the trades that go on every single day in the market. But as I explained to you in the first slide that I ran through, our background, fundamental analysis and fundamental thesis on investing has not changed. And the risks that Friday highlighted to the market, we had very much taken into consideration. Interest rate moves and reactions from central bank are one of our primary risks in the portfolio. Where does that come from? That comes from global growth or inflation through wage growth, leading to global growth being sort of higher than what's optimal. The ideal situation, this Goldilocks type environment, is global growth ticking along at sort of 4%. If it goes to 5%, if it goes to 6%, people do start getting concerned that the central banks will essentially tighten us back into a recession. So very much the mood from us is keep calm and carry on. There was a snapshot out this morning or last night explaining the rationale behind all of that. So if you want to sort of a quick read of that, that will summarize what I've just said. But our asset allocation hasn't changed as a result of this week. We are expecting increased levels of volatility. Thank goodness, not the kind of thing that we've seen Monday, Tuesday, but more than what we've been seeing over the last 3 years, which again is something that we've been clearly signposting the last couple of years to our investors and our clients. We have had a few questions pre-submitted, so I'm going to actually just start by asking David a couple of questions, and then I believe he's going to ask me a couple that he's received through. So David, the first one I've got here is, what is your view on what will happen with the DB market over the next 18 months?
Well, I think this is really looking at the nature and the activity around transfers and the high levels of CETVs that we've been seeing. And of course, the value of the CETV is there's a direct binary relationship with the behavior of gilt yields. And if we start seeing yields tick up, that potentially will have a negative or a downward pressure on the value of CETVs. So yeah, I'm interested to see when we look at the Q1 numbers into Q2, how CETVs have behaved in the first half of this year. I suspect we'll start to see CETVs just coming down as a result of yields ticking up. I don't expect to see a huge step change in the value of CETVs, and consequently, I don't expect to see I don't expect to see the amount of activity around DB transfers diminishing to any great amount. And I think that view is very much echoed by the regulator, the FCA, which you may be aware there's going to be a document coming out sometime this quarter around the regulator's revised position on DB transfers. That's something worth having a look out for. So yeah, I think possibly we may see CETVs, they may have topped out. We may start to see a gradual decline, but I don't think anything significant. But it'll be interesting to see what the Q/Q2 numbers look like when we get to that point.
I think the next one I've got here is a bit of a sort of depressing one, but it's something we have had a few times. What do I recommend to a client who is nervous about equity markets crashing?
Well, that's always a really difficult question, and I think when's a good entry point into markets? And well, gosh, there's been reams of academic studies around that. The idea that it's very difficult timing the market. I think is that the most important. And I think a lot of the work that advisors do with their clients is they're not looking to trade as such, they're looking to invest. And the two things are very, very different, of course. And the longer term time horizon and tax planning that advisors do for their clients and with their clients means that when you see these market corrections, yes, it can be disturbing, but if you're looking at 10, 15, 20, 25-year time horizons, the one thing that cures volatility or diminishes volatility is time. And yes, sometimes it can be quite galling if you go in and the market's 7,300 or 7,400 and it's fallen off to 7,100 or whatever the number may be. For clients, that can be disturbing. But it is very much a case of time in the market, not forget the importance and the alpha, if you want to put it in those terms, that an advisor's tax planning can do to add to the return. And I think basically it's a case of time in the market as opposed to timing. Phoebe, so a couple of questions for you which have come through. What do you think in terms of investing in fixed income and rising bond yields? This is a perennial question. So how are you investing in fixed income with rising bond yields? What's the view?
Yeah, so I haven't mentioned fixed income at all in terms of our positioning. That's not because we're not invested in fixed income, but we have, for the main part, handed over the credit risk control, the duration risk control to strategic bond managers. So throughout the portfolios, we use a range of different strategic bond managers that each have a different sort of risk mandate, that each have a different return mandate. And the blend of those depends on which portfolio we're talking about, from defensive through up to adventurous, of course. By handing over the control to a strategic bond manager, they are able to go in and out of the markets at the speed with which they need to do so. We don't really want to be in a position where we're actively choosing, for example, to allocate clients' money to high yield bonds, because we'd have to be moving much quicker than on a monthly basis, potentially, to be making enough alpha, or actually, more importantly, to controlling the risk in the portfolio. Because the moves that have happened in high yield markets over the last year or so have happened very quickly, and we believe the best way of controlling that is by using a strategic bond manager who has a very clear process and is able to, in some cases, be unconstrained and invest across the fixed income market. Yes, bond yields are rising, but actually most of the bond managers we use, and particularly our point to one run by PIMCO, they're long-short bond managers. So the PIMCO fund can make money both when bond yields are rising and not. And actually that fund is one of our lowest risk funds. It's targeting about 2.5% return a year. And it's pretty much a sort of cash proxy in the portfolio. So it's possible to really have low risk holdings in the fixed income sector. We just have to be very, very sure, and a lot of our internal research goes towards this, that the process is in place and they're really achieving the mandate that they're set out to do.
Lovely. Well, I think we've come to the end
Yep.
of our allotted time. I'd like to say thank you very much to all of you for tuning in to this webinar. We wish you a really good day, and we hope to see you soon. Thank you very much.
Thank you.
Bye-bye.